In this video, we're looking at the balance of payments, and it is a financial summary that countries might keep to track all of their inflows and outflows that occur through international transactions. So here's a long list of international transactions that might occur over any given period of time. So take a second and pause the video just to have a quick read of all of them. And what you'll find is that each different transaction kind of has a different, nature to them. Sometimes they involve individuals purchasing goods or services. Sometimes it's about international transactions that flow through the financial sector. And sometimes it's also about the government engaging in transactions. What's also important to take note of is that these transactions are also inflows and outflows. And so the direction of money is also changing. So because there's so many different types of transactions, we need a sort of statement that summarizes all of them. By doing so, we can see what is our total inflows contrasted with our total outflows of money. And so the balance of payments is an indicator expressed in Australian dollars, and it summarizes all the different transactions. And so we could group things like maybe all the dividends payments together, or the interest payments together, and maybe all of the services together. And what that allows us to do is give us a better picture of maybe how much Australia depends on international trading partners, how much we sell to them, how much imports we buy from them, and it highlights the dependency of foreign markets. Now, before we look at what's inside the balance of payments, it's first really important to understand how the numbers are displayed. And so what we need to do is know the difference between a credit and a debit entry. So simply put, if you're seeing a credit entry in an account in the balance of payments, that's representing an inflow of money, or you can interpret it the same way the Reserve Bank of Australia does, and they say when economic value is provided. And in return, obviously there's going to be an inflow of money. Examples could be the sale of goods, shareholders receiving dividends, or we're receiving transfer payments. And the RBA also lists that when economic value is received, we make a debit entry. And what this really means is there's an outflow of money and we're buying something that allows us to receive this economic value. And so we get a debit entry. And so examples could be us Australians buying American stocks, big banks paying out investors, or maybe the government or financial institutions making their interest payments. So there are two major accounts of the balance of payments, and it splits up into, these two branches. And the first one is the current account. And the main idea with the current account is that it records transactions that do not require future obligations. So there's a very big difference between purchasing a loan, which is obviously going to have multiple interest payments. But when you compare that to a single interest payment transaction, once you make that interest payment, there is no more future obligation attached to that sum of money. Now, contrasting that to the capital and financial account, it records all foreign investments and funds that are of a capital nature. And so typically they will require financial obligations. So let's have a look at the current account, and it's comprised of four major categories. The first one is net goods, also known as the balance of merchandise trade. And it's the revenue that we receive from exported goods, minus the import spending Australia engages with from other countries. So an example is the purchase of physical goods. Now, net services follows the same logic, except we're obviously selling and buying services instead. And so some examples that you might think about is the tourism industry, the education industry. Sometimes we purchase financial advice. There are also freight and also transportation costs as well. Now, one thing to highlight is the importance of the word net. And anytime you see the word net, it is always indicating the difference between the inflows versus the outflows. So if a net value is going to be negative, it means that there's more outflows than there are inflows. And if the net good or net services value is positive, it means that we've received more inflows than we have outflows. The final two transactions or broad categories under the current account is net primary incomes and net secondary incomes. Now, with net primary incomes, it's about the payments or revenue that we receive from profits and interest. So for profit payments, anytime you make an investment on equity, in the future, it is more than likely that the company that you've invested in is going to pay you back in profits. And we see that through things like dividend payments. Now this is different to interest payments because that's money that we either pay or receive on debt. And the word debt is related to simply cash or money. Now for net secondary incomes, these are typically about transfers. How you define a transfer is when there is no exchange of goods and services. So it's a one-way payment or a one-way transaction. And so some examples of one-way transfers are things like foreign aid and also pension payments to maybe citizens that are currently living overseas but have still retained their citizenship in Australia or whichever country that they've come from. So once you gather all your inflows and outflows and you put them in their proper category, what you're able to see is a nice summary that occurs in the current account. So for example, let's just make hypothetical numbers here. So what these numbers are showing is that, for example, if we look at net goods and we're calculating the value and it's come out to a plus 50 billion figure, that means that for a particular year or whatever period we're looking at, we've sold an additional $50 billion worth of goods than we have spent on goods. For net services with a negative 30 billion, it means that we've spent an additional $30 billion than the amount of services that we've actually sold. Net primary incomes is the same story. With plus 20 billion, it means that we've received more incomes from profit and interest payments. And for net secondary incomes, if it's a negative $10 billion, it means that we've made more one-way transfers out of our country than we have received. And so if we add all these values up, you're going to get a balance figure. So for this example, it is going to equal 30 billion. And so if the sum of all these figures is going to be a positive number, then the current account balance is going to be in a surplus. Now, if the figure came out to be a negative number, then what we call that is the current account being in a deficit. So this is kind of the visualization of the balance of payments, and we've now looked at the current account, which is on the left side. Now let's have a look at the capital and financial account, also known as the CAFA.